This is our second meeting this month after a very successful recognition ceremony that we had in Canary Wharf a couple of weeks ago. I would also like to remind you that the deadline for early registration for FRMs is approaching, is actually this Friday if you wish to register. Tonight we are honored to have here Mr. Gudni Adalsteinsson, a liquidity risk specialist and currently the head of global liquidity at Legal & General Group. His experience ranges from running the group treasury for a European bank during the credit crunch, working for the FCA, to providing liquidity advice to UK banks. Gudni was a group treasurer for an Icelandic bank during the liquidity shocks in 2008, which offered him first-hand experience of liquidity risk management under severe crisis, and then a manager for asset liability and management at one of the Irish banks. Between the years of 1998 and 2005, he was an executive director at Lehman Brothers and Credit Suisse in London and Frankfurt, advising German banks on their liquidity and structured credit investments. He has been a board member of banks in the UK and Denmark. He earned his bachelor degree in economics from the University of Iceland and his MBA from the University of Cambridge. So I'll pass you to Gudni. Thank you very much.
Yeah, you heard on the introduction that wherever there's been problems, there seems to be close to where I am. Lehman Brothers, Icelandic banks, Irish banks. So that seems to be my history. But thanks for attending tonight. I see we have almost a full house, and I guess that is due to the name of the presentation. I thought if I would make it a bit punchy, people would think they have to come to see if they're missing something from their own liquidity framework. But not quite so. But what I wanted to do tonight is to give you a bit of a glimpse into the principles of liquidity risk management. And hopefully for those of you who are sitting on a liquidity management desk or in risk function in a bank, I'll give you some ideas to apply in your own day-to-day operation, your own work. And for the rest of you who are perhaps in a different area or perhaps not even in banking, I will then give you hopefully some insights into what liquidity risk is all about. And then talking about liquidity risk is always very comes in handy in dinner conversations or weddings, stuff like that. It's always a nice topic to talk about. So you can use actually liquidity risk in a lot of different areas. What I thought was interesting actually when I and that's kind of where I started with this liquidity risk of mine, was that many years ago I was looking into bookshelves in a typical Waterstone shop, and I realized that we risk professionals, we perhaps have been ignoring liquidity risk to some extent. There's probably one liquidity risk book for every 40 books written about credit risk. And I was actually wondering why that is. And even GARP, I was looking at your agenda, liquidity risk has not been a topic for many meetings. It's been rather about other stuff. And so I started to ask around, and apparently the reason behind that is the lack of data, and we'll come into that in a minute. Risk professionals, they like to have data, they like to be able to analyze and model back and forth, and if there's nothing to model, nothing to analyze, they just say, well, that's not risk then, and we can just move on. And I think that's perhaps not the case. Liquidity risk is definitely something that we have, and as you know from the past, it's something we have been dealing with. But what I have put together, this is a typical disclaimer, and then is agenda that I hopefully will enable us to have a framework or a toolbox to what I call expect the unexpected. And that's what liquidity risk management is all about. We'll come to that in a minute. And what I'd like to emphasize, and this again is just my personal view, I'd like to emphasize the approach in liquidity risk management, which I think is the most important factor. Secondly, the principles, of course. Talking about the approach, it can be quite a lofty statement, and people might say, what do you exactly mean by that? That needs to be supported by something more tangible. And there I have created something which I call the 6-step program, which effectively is one version of a liquidity risk management framework. If we add that to the approach, and then secondly or thirdly we talk about the possible pitfalls within liquidity management, Then if you add all these things together, we have A, B, and C. We have, I would say, a workable toolbox which enable us to expect the unexpected. And I will use that phrase from time to time because I think it's quite important to look at how different liquidity risk is to other risk factors. Then I'll round this up by throwing out a couple of questions. The first one is liquidity risk gone? What happened to liquidity risk? And where is it likely to emerge again? I believe, like so many others, that liquidity risk is definitely not gone. It's still out there, but we still have this a bit of almost delusion that it is, which we could call out of sight, out of mind. And we'll talk about that later today, that it might have shifted, it might have gone to a place which we least expect. And then the last item is the big question, is can the perfect storm happen again? And we'll talk about that in the end, and that kind of is probably what we all want to know a bit more about. So the first one is to have a framework or approach is to perhaps look at the fundamentals of liquidity risk. Why is the approach so important? Why do I keep on hammering that point through? Why is it so different from other risk factors? Probably the best thing to do is to look at some examples from the past. This is what you see here are some of the systemic crises we've had for the last 25 years. I think they're like 14. So this is almost like what? Every other year we have some sort of a systemic event, which is actually quite surprising. So what can we learn from these events? What do they have in common? If you look at them, there's not much, if anything. The only thing we can actually see from the list is that no two consecutive events seems to be similar. That's, I think, is number one. But there are also other things which we can derive from this, and is that liquidity risk doesn't seem to happen in a vacuum. It seems to be, most of the times, a consequential risk. Example from the list would be, let's look at 2008, the global credit crisis. We have this subprime crisis in a medium state in America, mainly known for sun and oranges, which then leads to people queuing up in front of a bank up in Sheffield. Definitely a consequential risk. So one might then say, well, the right approach to liquidity management is to look at other risk factors, follow them, and if something comes up, then we start our liquidity risk models. That should give an ample time to spot the risk coming up. But unfortunately, that's not even possible. Actually, I've highlighted the last event, which is the Swiss franc. We already have had a liquidity event this year. There were at least 5 firms that went belly up 13 days ago after the Swiss francs they stopped capping next to the euro. We might have later in the year, we might have Greece, we might have some fluctuation around the EMU, we don't know. But at least we have had this one event, that event we actually couldn't predict. That we can say came out of the blue. And what does that tell us? It tells us that we cannot just look simply at other risk factors. Usually, this is the way liquidity happens, but not all the time. Or sometimes it comes out of the blue. That is not very helpful, is it? It doesn't really help us building up a model, but it tells us that the approach we're going to do needs to be wide and needs to be almost all-encompassing in a way. Again, it's very lofty statements. How do we kind of bring that closer to the ground? Again, one side step more. Liquidity risk has different characteristics than other types. And again, I like to highlight the difference just to demonstrate what the framework needs to look like. First of all, there's not a single definition of liquidity risk. You can flip through a lot of the books, and compared to other risk factors, there isn't a single definition. If it's not a single definition, And how can we agree on how it's managed? It's kind of obvious that if we cannot agree on the definition, that we will have problems. Secondly, we can say that liquidity risk isn't visible. We cannot really learn from the past. It's actually quite an interesting thing that working in liquidity risk for most of, you can actually be a liquidity risk manager and never see liquidity risk for all your life. That's like being a firefighter without ever seeing a fire. It's a very strange job. Or imagine a credit analyst who's never seen a loan default. What would he do? So it is a very hypothetical job to do. So liquidity risk is definitely not visible. So what I've done here, actually, I've compared it to credit risk. And this is my view. I'm not a credit risk expert, but this is my view on the credit risk platform. It's well identified. We have strong data. We know about the main correlations in credit risk. And hence we have moved from the approach that has been all done and dusted. People know exactly what we're going to do and try to improve the modeling. That's where we kind of were taking that factor. Compare that to liquidity risk. Again, very vague theoretical background. We don't agree on a definition of liquidity risk. Limited historical data. Ever-changing assumptions. Example of that would be, again, the queues that happened in front of Northern Rock in 2007. If a similar bank would default in England today, would people queue up? I don't think so. People have much more knowledge about the FSCS, the Deposit Guarantee Scheme. They would probably just stay at home and wait for the money to arrive. These are definitely a changed assumption from 2008. And that means, again, we need to have that in our model. We need to look at the nature of the risk. Difficult to see and measure. That's one thing that we know for sure. And we cannot learn from mistakes. We cannot sit in our seat and let the bank default every now and then just to check if the model is working. At least that would be kind of the wrong way of doing it. So we have to have a model or have an approach that tells us effectively to start at the beginning every time. Review and start again. So the focus is more on approach rather than modeling. And focus on finding the appropriate approach, appropriate framework rather than appropriate modeling. People might have different views on this, but I think this is kind of where I'm coming from and how I see things. So why is that kind of irrelevant? Why is that relevant to what we do? Because what we've seen in the past is actually that we have done a lot of the modeling, and we have made mistakes by simply looking at models and believe that what they told us was the right view of the world. And again, this is all about the point of view. So we need to make sure that the tools we have, they enable us to see the risk. And what happened in the past was that many of the times the tools did not give us the right standpoint. So people were looking at the matrices, they were looking at dashboards and saying, from my point of view, I don't see any risk. And the reason for that, they probably were facing the wrong way. And I've taken an example of these two gentlemen in a sea somewhere south and say, don't worry, Bob, everything looks absolutely fine where I'm standing. From their point of view, they don't see the shark that is just behind them. But they are right. From their point of view, there is not a risk to deal with. So this is exactly a kind of a metaphor around what I see in the liquidity risk framework is that we need to have the principle and approach set up correctly so we will capture the nature of liquidity risk. So again, this is the framework part, and now we try to bring it down to something more tangible. Well, when I ran Treasury for Icelandic Bank throughout the crisis in 2008, I looked after all these, when all the bricks came tumbling down, I looked at the framework and thought, okay, what was in the framework that didn't work properly? Or was there actually a framework that would have been more appropriate? Then I realized it was perhaps not the models that were wrong, but it was rather the framework that people used. The nature of risk had not been properly identified. Later on, I was working in another bank which actually didn't have a problem with a shark, it had a problem with a whale, you can say. It had The opposite actually was a bank that had previously ballooned with deposits, didn't run out of money like some of the Icelandic banks. On the contrary, it actually almost doubled the size in 3 years due to a government guarantee that was placed on deposits. And the problem that bank has was they looked at that and said, we never have had this problem before. It's a luxury problem. We have too much money. But are these money any good to us? Can we use these money to lend out? Luckily, they decided, no, we can't, because we don't have any historical tracking data on these deposits. We're not going to do it. Luckily enough, because short time later, the world turned, and the bank lost all of these deposits extremely quickly. So you can see the nature of the risk is, again, always changing. So that's kind of what started me thinking about liquidity risk and thinking about a framework. And I was very lucky to work for a few months for the FSA on what I did was actually I was looking at liquidity frameworks of banks in general, and not English banks, just to be sure that these were foreign banks. And I thought, well, I'm in a great seat. I have this pile of frameworks from all the best banks in the world, and usually you don't get this kind of a global view on what you have. So I thought I'm going to really see the gold standard. What surprised me is that the approach, they were as different as there were many banks in the world. And you could see this was in, let's say, 2010, and I flipped through some of the frameworks for the biggest banks, and they were still talking about how they would measure their exposure between French francs and the Italian lira. Italian lira hadn't been there for 10 years. So you question, like, how frequently do they review these documents? Also turned out that what surprised me is that it was obvious that many banks, not all, some of them are actually very fantastic, but some banks had started out saying, liquidity risk, we need to do something. What do we do in liquidity risk? Yeah, we need to do stress testing. Let's do that, do a bit of stress testing, and let's build the framework on top of that. We need to send out the results. Yeah, let's do that. Somebody needs to prove it. Yeah, yes, let's do that. So they started out on the wrong end. They started out in the output and worked their way backwards to the input. The conclusion was wrong. So what surprised me when I got this opportunity was that there was not a single identifiable denominator between these banks. Not a single way, as you would expect in credit risk, where you kind of go from one bank to another. Yeah, you know the basics. It's a standardized or advanced model. Yeah, you know what's going on. Absolutely. And even the larger and bigger banks, we would all believe are fantastically strong and are famous names across the world, they would not have the best framework we would expect. So this was definitely, I thought to myself, this is definitely not some sort of Icelandic problem with banks with not a good enough framework, but actually probably a global problem rather than anything else. And that made me kind of sit down and think about how a good framework should look like. So a good framework needs to be, and this now we're going away from the approach and we're trying to drill down to a usable framework. So that needs to answer 3 questions. That needs to tell us how stable is our funding base. Then secondly, how liquid are really our liquid assets? Can they be sold under transfer stress? Yes or no? And then at what kind of haircut? And then thirdly, how much time do we have to sort out the problem? So if a framework can answer these 3, 1, 2, 3, we have actually quite a useful approach. There is there are kind of 2 schools of thought here. There's a bottom-up or top-down. A lot of the old frameworks, they are bottom-up approach. There's somebody who found a great stress testing model and built everything on top of it. I'm trying to advocate more for the top-down, where you try to analyze this from above, and we'll talk about that in a second, how you do that, rather than starting at the stress testing factor. What you could end up with there is that you have effectively the tail wagging the dog if you start on the other side. And I've seen models or seen frameworks which had 15 different ways of analyzing retail deposits and only one way of analyzing wholesale funding. Rest assured, looked again at the bank. The bank used to be retail funded, but was now wholesale funded. So their methodology only applied to a small proportion of the funding, because they hadn't changed the framework in line with the current business model. And this is what happens if you start at the wrong end. You will end up in these type of situations. So the list of essential ingredients, this is like baking a cake. You need to have the right ingredients, and these are the few things you need to have. Stress testing, cash flow projections, contingency planning if something goes wrong, governance and policies, we all agree on that. Funds transfer pricing, that is something that all banks are now really focusing on, trying to get to grips in how to charge for the uses of liquidity. It's actually a science by itself. And then some sort of a escalation and monitoring framework. So how do we make this stick together? You might say, and people might say, well, if we do all these things, what are like 7 things, we should be fine. But it's actually, what's important is how to get, and that is the framework I'm trying to promote, is how to make these things stick together. And what I've put there together is a 6-step framework. I put it up as a ladder because to emphasize that one step is related to the previous step. You can't, well, you probably could jump, but jumping is not recommended on those stairs. So you need to take a step and effectively start at the beginning. That's the most important factor. And the first step is what I call identifying the sources of liquidity risk. This is something that many banks have, tried to skip. They've gone straight to the stress testing, and they say, we'll just do stress testing and then we'll find a way out to distribute it within the bank. My method is to say, well, and I'll provide a assumption to do that. Every year almost, or every time there's a change within a bank or an organization, you need to look at the nature of liquidity risk. Once you've done that, you have a measurement system. You can actually know what you are up against. Around that, you could then say, well, this is liquidity risk. How much liquidity risk is the bank or the organization willing to take? And you formulate that into an appetite statement. Otherwise, you never know actually when you reach your boundaries. Is 20 million too small or too much? We don't know. We have first to identify the appetite. The third step, again building on what has happened in the previous steps, is to have a governance framework in place and policies to implement the risk appetite statement. And some banks, again, do not have this set up. Fourth step, on top of that, is the quantitative measurements. This is something that I think most banks actually do quite well. They measure the liquidity risk with all kinds of ratios and measurements. Then stress testing. All banks do stress testing. And now this is actually a dual process called stress testing, and CFP, contingency funding plan, is the take them together. And then the final step is just reporting the results. So this might sound like a very simple procedure, but the reason I want to do this in this row is that it makes sure that the results that we get in one step is going to be used in the following step. So right here we might analyze the source of liquidity risk, and if we build these step by step, we'll be sure that the liquidity stress test we have, they address these functions. The assumptions that are being used in one step are also being used in later steps along the way. And I think that is what makes this framework slightly different than some of the others. As an example of a framework, this could be actually step 3. This is something you would see in most banks that have done this. It's a risk appetite. It's a top-down. It's a risk appetite set by the board who says this is a liquidity risk we're willing to accept, and not more. We have a policy which defines it. We have a funding strategy. We have a contingency funding plan to capture if anything goes wrong. And we have the stress testing. And underneath that, we have the different level of policies. I'm not going to go through all the different steps. I'm just going to highlight the ones I think are interesting. And probably the biggest one is the first one, sources of liquidity risk. This is something I've adopted from the PRA. It is quite important to have a model to analyze source of liquidity risk, to analyze the distinct source of liquidity risk. A lot of times when people do this, They are just finding a different crystallization of the same problem. But we have to find what sources are definitely different from others. And this is what I've used. It's similar as a program as you can call the Porter's 5 forces model. It forces you to think in a certain way to analyze liquidity risk. If you take this and apply these questions to almost any balance sheet, you'll be able to identify all the risk factors within that organization. And it has all the things that you would say you would need. You have off-balance sheet risk is quite important, and this should also be cross-currency liquidity risk. That was the example we talked about the Swiss franc. So you can see that this should, if applied properly, should capture everything that could happen. What I've added to this thing, which is not in the FSA module, is a correlation risk. Liquidity risk and correlation risk are actually correlation risk plays a big part in liquidity risk and should be analyzed separately. It's a very difficult thing to really focus on due to the dynamic nature of correlation risk, but it's something that I think every bank or organization needs to put a lot of time into. We'll talk about that in a minute, but since most of the funding channels are interlinked in one way or another. Again, so if you take this, and you can actually apply this to anything. I'm actually using this as in an insurance company which I'm working with currently. And so this can be used at banks, it can be used in insurance companies, also on corporates. But I'm going to focus, and what I'm going to do next is focus on probably the most important factors of these two, which is the wholesale and retail funding risk, just to take an example of how this can be applied. So remember the question in the beginning, what a framework needs to have. That was supposed to determine the stability of our funding. So now we're looking for sources of liquidity risk, and we are going to try to determine the stability of funding channels. And effectively, funding is just cash flows. And cash flows, we have 4 types. We have the easiest one, which are the one here on the corner here. The amount is certain, and the timing is certain. Typical bond would be an example of that. Bond is maturing on June 22nd of 10 million. It's quite simple. Then on the right-hand side, we have the amount, which is certain, but timing is uncertain. Current accounts would be an actual example on that. That's something that banks spend a lot of time on trying to figure out how it's going to work. On the top left-hand corner, we would have a floating rate note. We know when it's going to mature, but we don't know the amount. And on the right-hand side, on the top, we would have off-balance sheet items. And strangely enough, the more uncertainty we have on the funding, like here, the more assumptions, of course, we need to use to determine the behavior, the less has been written about it. So people spend a lot of time writing about how to model on-demand deposits. You can find quite a few books around it. How to capture off-balance sheet items, which both the amount and the timing is uncertain, is something that, again, probably due to lack of data, is something that people really haven't focused that much on. But there is a way of trying to bring this into some sort of model, and the PRA has come forward to this model. Prescriptive model, they say, well, if it's retail type B means it's guaranteed by the deposit guarantee scheme, it's very stable. If it's not guaranteed, i.e. slightly bigger deposits, but still retail, it is slightly more risky. Then if it's wholesale, which are corporate deposits, small ones, then they are slightly more deposits, and the most risky ones are wholesale type A. So the PRA has decided that this is the role of stability. But all the time, retail is more stable than corporate deposits. A is less stable than B. So this is kind of a one-dimensional framework, and therefore can lead to the wrong conclusion. We can have a situation where corporate deposits, let's say deposit from a client that's been with the bank for ages, is more stable than an online deposit that was taken in yesterday. This model, this way of categorizing, would not capture that. Basel III is another example. They've gone to actually two extremes. So they say, they go basically all the way, and they say if the deposit is guaranteed by a scheme, it's actually extremely stable. If, however, it's a corporate deposit, it is extremely unstable. So they've actually taken the market and cut it into half. It's a good way to analyze things, but does it necessarily hold true? I'm not sure about that. So what I have built up is an alternative model, which is like a scorecard. I'm not sure if you can see this, but what I have done is to say for every class of deposits which you have on the vertical scale, they could be online, it could be corporate, it can be anywhere. You ask questions which define the characteristic of the deposit. So you ask, like, is it a big deposit? And if it is, you give it a score. If it's very big, you give it 5. If it's slightly above the normal, let's say above 100,000, which is the guarantee mechanism, you might give it a 2. Is it placed by a professional money market holder, or like an individual? If it's individual, you get 1. If it's a fund manager, get 5. Is it? Do we have another relationship with our counterparty? Does he have loans with us? Has he been a long-standing client of the bank? Again, 1 to 5. So this is kind of a scorecard approach which I've developed, and this has been used now in a couple of banks to move away from simple having yes or no, black and white, wholesale or retail, to give them a flexible score. So you add this up on the end, and you get something like this. You call the category A1, and you can see the amount of deposit this particular bank has of category A, which is the stable one, and then you take it up on notch by notch, and the category in this case 7 is the most unstable. To stress test deposits and to analyze them, we need to use a system to categorize them. Otherwise, we have to take each and every client and try to model each and every client by itself, but that's not going to work. So we need to have a mechanism like this one. It is a relative mechanism. The outcome would have changed if we would have said that being unguaranteed deposit would give you 10 negative points, not 5. But it is still, however, probably the best way, even though it's objective, it's probably the best way to rank deposit by stability, rather than assuming that wholesale is bad, retail is good. As a side note, and there's something I like to talk about, is that liquidity risk management doesn't just need to be about the risk. We can also alleviate that what we do into making money for the organization. It should also be useful to make money. What I've done here is to map together how attractive the deposit is, and that means effectively from a risk perspective versus the availability. And availability means if it's cheap, we'll do it. If it's expensive in the market, we don't do it. So here we can actually map together what the risk manager would say versus what the market would say. So we can actually take the risk models and say to the guys who are doing the funding, yeah, it's great for you getting all this cheap source from the wholesale market, but looking at the risk metrics, they're not actually that good of a bargain. So it gives them a framework, gives the funding guys a framework to operate on, which is not simply pricing. Now we talk about that in a minute. A lot of the problems we've seen in the past is that the funding people, they've been allowed to operate under their own parameters, which number 1 is getting the cheapest source of funding. Number 2, getting the cheapest source of funding. And they've not been as much pressurized or haven't mapped themselves into the liquidity framework to say, well, actually I can do this funding, but it's not that great funding for the risk parameters of the organization. So this is a way to take what we do and apply it to for making money for the firm. Just jumping into the measuring liquidity, which is the step number 3 or 4. This is somewhere where banks haven't completely mastered it yet. There are effectively 2 ways of looking into this. This is typical balance sheet measurements versus cash flow analysis. And I'm just going to shoot to this slide here. You can see actually, if you look at the third this is actually a survey that was done 5 years ago. This is the ratio of banks that do cash flow analysis. It's only half of European banks that do that 5 years ago. The rest of them are basically only looking at liquidity as a static factor that they use, which probably is the only way to do it. If you think about it, if you just take the financial accounts, you open it up and say, yes, I know exactly how to do it. I'll just take the short-term assets, short-term liabilities, I calculate the ratio, and I have a metric. It's fine. And you see a lot of these balance sheet measurements being taken straight from the financial accounts and being used left, right, and center, and they try to analyze and use that as the liquidity tool. There are actually a lot of shortcomings to that approach, and actually it's interesting to see that only half of the banks have done something more than that. If you just look at if you just take balance sheet analysis, you are bound by the information that are in the financial statement. There's nothing in there that tells you about the time. I remember we talked about how much time do we have to save the bank. There's nothing in there that will tell you about the time element of liquidity. Still, however, they are quite a good measurement if you want to look at the structural funding franchise of that particular organization. It will tell you if this bank has all the funding from retail, all the funding from wholesale. So it's a good way to see the structural side of the bank, but it's not going to tell you anything what could happen tomorrow. Financial accounts by the nature about the past, but not about the future. So in terms of having a liquidity risk management model, you need to do forward-looking analysis. It sounds obvious, but again, half of the banks haven't really come to terms with it yet. So stress testing, the heart of the liquidity risk management. The purpose effectively was, he has a lot of different purposes to do this stress testing. You need to, of course, to save the bank if something goes wrong, to quantify the liquidity risk, and also to have a measurement which would tell you when to activate your emergency plan. So these, we could say, are at least 3 reasons to do this. The problem here with this is, of course, a lot of the things we said before are reliant on assumptions. And when we have a modeling framework that has assumptions, then like that, we need to probably rely more on scenario stress testing than models like value at risk. This has been kind of become a standard in liquidity risk modeling, is to and the Basel III and the PRA models. They have these deterministic models, or the scenario-based models, over the value at risk models. And what people say about them actually is that yes, they are limited by the assumptions that you give yourselves, but it's not the best model in the world, but I would say it's the least worst model. And that is what been kind of used to describe the scenario-based stress testing. Value at risk is effectively not usable in liquidity risk, apart from where you are valuing assets like your collateral, or perhaps off-balance sheet items. You can use value at the risk models there as well. But the rest of them, even though banks are still trying to do it, most of the time it doesn't really work. And why is that? Take an example. Let's take the Swiss franc problem. 15th January, the guys in Zurich decide that the Swiss francs should not be capped against the euro. if you would have a value at risk model, you would never capture that risk. There hasn't been an event like that before. So it would be kind of impossible to predict it. So this kind of has been crystallized in the black swan model. A black swan is something like, the theory goes like this, that no matter how many observations you have on white swans, it doesn't enable you to predict if and when you will get a black swan. And apparently back in the old days, people believed that all swans were white. There are some black swans. So example of that would be the Swiss franc problem. Came out of nowhere, unexpected, unprecedented, and could not have been captured in the models that have been used until now. But there is and has always been a debate amongst risk specialists if value at risk in this perspective is dead or not. The reason to use scenario planning and the scenario stress testing is first and foremost that it captures if the nature of the liquidity risk has changed versus the quantum. Liquidity risk is not necessary just to decide the quantum. It's quite easy just to say that if you are a risk appetite statement that this is where we're going to draw the limit. If our stress testing is just about moving the quantiles left to right, then that is not a very difficult thing to do, and that doesn't really help us that much. What went wrong in the past was not that people underestimated the liquidity risk. The outflow were not just 50% where people thought they were going to be 30%. It was the nature of the liquidity risk changed quite dramatically. Now this is something that historical models can never capture. So the examples of scenario stress testing in liquidity risk management is effectively just blue sky thinking. And I've seen in the past that the only way to capture things like, again, the Swiss franc, is to allow blue sky thinking when you do this. You have to throw in scenarios which, by the sound of it, sound unlikely, but you can't really start on saying, well, that's not going to happen, let's not put it in there. By having these type of scenarios, those organizations that had this problem with the Swiss franc, they would have been able to identify it. They would have been able to meet them. So the list, of course, is quite firm specific, and it basically goes down to the fact that you get a lot of hopefully different people in a room, and you start flexing out as many scenarios as you can. What you need to do is you need to have some sort of balance between firm-specific scenarios, market scenarios, and some that would be both internal and external. So if you flex them out, you get something that you can actually cover yourselves from many different types of nature risk. It does not mean that, I'll show you the next slide, which effectively is scroll over there, is the outcome of a stress test. Set out as survival days. So one stress scenario would say that the bank would survive for 130 days. Another scenario will mean the bank can live for 200 days. You're not trying to put in scenarios that would actually happen. You're just trying to see what is the range of outcome and how the bank would look after each event. You're not trying to predict the future. You're saying, well, taking a lot of things into account, we have scenarios that tell us that we have between 130 and 200 days to survive. And this is usually done in this fashion here. This is just one way of presenting the outcome. The first line that is usually reported are the predictable outflows, the ones we have in the left corner, because they are undisputable. The second one, we have the ones where we need to put in some assumptions. There we can see how much of the liquidity profile of the bank is subject to assumptions and what is actually fixed. Some banks have everything right here and do not need to worry about the second thing. And then the third element which we add to the equation are the mitigation action that we have. We can sell our portfolio, we can repo stuff out, we have something to mitigate this risk. And down there we have then the cumulative position, which is then used, and I'm kind of scrolling over this, to calculate this outcome. And this, again, is not a description of the truth. This is just to give an idea what the bank could be possibly against. So when this is done, and we all know what about, the only thing we know about these assumptions and this outcome is that they are wrong. We know this is not going to happen, but it still gives us indication of the quantum of the risk we have in there. So what is usually done after this is do sensitivity analysis of the biggest assumptions, and there we can go back and say, let's look at the most difficult stress assumption, this one here. And this one might say that retail deposits will run out at the rate of 20% over the next 3 months. And that might be the most important assumption in that model. So what we do then, if we take that and we sensitivity check it, and we say, well, actually, let's not put 20%, let's put 35%, because we don't really know what's going to happen. And then after that, we usually do sensitivity analysis of the extreme scenarios to check how sensitive it is to certain and the most important assumptions. And this is the way we kind of benchmark our scenario testing. There's a whole school of modeling of non-maturity products. And there are firms that specialize in making these models and selling to banks. They're actually quite interesting. They do tell us about that on-demand deposits, current accounts, they're not static, they move. They try to put some sort of a behavioral characteristics over those deposits and try to find the drivers that drive the behavior of these type of deposits and try again to knock them down in different subcategories. These models, I still haven't seen one that is actually useful to predict liquidity events. Liquidity events, something that happens rapidly, happen fast, but they are quite good to determine a structural change of a balance sheet of a bank. So a bank that is, let's say, is on the Sunday Times Best Buy list with most of its funding, it needs to know how sensitive it is if it's not longer in the top 10 league table. It's not going to kill the bank today, it's not going to kill the bank tomorrow, but moving away from that table might effectively destroy the funding franchise. So this is actually a model that, or models are usually more helpful in funding strategy rather than liquidity management. There are 2 types of them. There's the option theory model, which are quite advanced. The typical option theory you can use on it because on-demand deposits are effectively like a free option to the bondholder or to the depositor. And then there are slightly older version, which is the replicating portfolio models, which effectively what you assume when you have on-demand deposit that it is a bundle of term deposits. So on-demand deposit is effectively 1/10 a 1-month deposit, 1/10 a 2-month deposit, etc., etc. Then you move it over time and try to replicate the behavior of an on-demand deposit with this type of proxy method. They have some interesting outcomes, but they're mainly to look at the ratio between price and volumes. Pitfalls. There's a lot of pitfalls in liquidity management. The one I would like to highlight are, again, these are kind of failures first in stress testing. And again, I think it's quite important to keep in mind. This is where a lot of the banks went wrong in 2008. A lot of the stress test framework, they focus specifically on the bank itself. They focus on the firm-specific risk. What if deposits go in and out, etc., etc. And they just assume, well, our liquidity buffer is all in AAA, and there's a market assumption that AAA bonds, they can be sold within a week. They don't have this factor built in that market risk, actually, market risk was the biggest thing that happened in 2008. Market risk was the thing that almost killed the bank. So that is effectively what a lot of the models have missed out on. The second thing is to fail to incorporate the off-balance sheet contingency liabilities and assets. And I think there's a good reason why this has been neglected in the past. A lot of liquidity models, they've been made by ALM people, not business people. And most banks, most corporations, they have, let's say, a group-wide structure. There's all kinds of entities that have been owned or been implicitly supported by the bank. a lot of time the ALM people, the treasury guys, they would say, well, if there isn't a guarantee between these facilities, we will exclude them. But if you ask the CEO or somebody in the management, they would say, no, we will support this subsidiary or this vehicle, whatever, until the final day. And this is what happens, that the ALM guys might have taken a very narrow viewpoint in terms of defining what is the risk at hand, and say if it's not guaranteed, we don't want to look at it. Whereas even banks, they have this kind of almost a moral obligation to save a lot of things around them. So this is something that has not been quantified. And you see this actually, this was heavily undervalued in the crisis that happened in 2008 and 2009. Banks thought in the liquidity model they could just let the subsidiaries go left at the center until it's not going to be a default if we let them go. And of course they couldn't. Underestimating funding concentration. This again is something that we, the risk specialists, can probably blame ourselves. We've looked at these models quite in isolation and haven't really told the funding people what the outcome is. Funding people, again, just chase the cheapest source of funding, and if some source is cheaper than others, they try to focus on that as long as they can. They have targets to meet, and they want to do it quickly and as efficiently as possible. And this meant that funding in the past, and still does today, moves quite quickly in the channel which is cheapest. And of course, it doesn't matter actually where it is. If it's too centrally focused on one or two instruments, there is a high danger. The fourth estimate in liquidity stress testing that we could say was failed is that there wasn't really a good understanding of the nature of the liquidity risk. What is it that makes somebody take out their deposit? Is it because it's not guaranteed? Is it the size? Is it because it's been brokered by a third party? Is it the age of the depositor? Is it because it's online? And these are like the nature of a lot of the funding that wasn't fully understood and explained. A lot of the banks took all the deposits that were below a certain size and pulled it together. A deposit that is taken from an online account does not have the same characteristic as a deposit of somebody who has his salary account with the bank and has been there for 50 years. Puts his money in the beginning of the month, uses it throughout the month. That person is probably as sticky as they can be. So a lot of the banks failed in understanding the different nature of the risk between these two. And I call then the shortcomings of the liquidity management regime, the 7 sins, slightly a bigger kind of problem. Not just the stress testing, but actually the regime as a whole. That is something I've kind of picked up along the way. This is a similar problem. The first problem is a similar problem as with stress testing. The failure to recognize the structural changes. Again, funding and liquidity of the bank can change, but there is a reluctance from all of us to change our models. And we still might have the same models that were fantastic 5 years ago, but the world might have moved on. Well, if a bank doesn't do cash projections, it cannot really do anything else than do retrospective analysis. Cash flow projections are the key to have any view of what's going to happen in the past. So this is something that I would say most banks need to have. If they don't, they should do it. And then the element here is that the past does not predict the future. This is kind of goes without saying. But there is a reluctance to put into the system something that hasn't happened before. The Swiss franc, as far as I can remember, has never bolted away from the euro. So if you just look at the past, you would say we don't need to have it as a scenario. It's not going to happen. But we need to kind of expect the unexpected and do things like that. This is something that also was a problem, and still is a problem with some of the systems, is that it might be a great system, but then if something goes wrong, and some of the policies I read, it means that you call somebody called John Smith. John Smith might have left the company years ago. And when you probe some of these things in organizations, not many organizations have a clear escalation structure. Yeah, we'll let the CFO know, And that's about it. Do we let the risk officer, do we let the subsidiaries know if things go wrong? Who do we call? And if you ask that question to a couple of people, they'll probably give you different answers. There's not a kind of a guide like you would have, almost like your fire rescue system you have in a building. It says exactly who you're going to call if something goes wrong. And this needs to be in place. Here was another fallacy of the liquidity management regime, that there has always been an assumption that business continue as usual. I'm going to talk about that in a minute. And in the old models, there was definitely always this thing that liabilities, you can just roll them over. Short-term funding program, we'll just roll them. There's never going to be any difficulty doing that. That was something that people definitely underestimated. Insufficient contingency planning. This is effectively that you need to have a rescue plan if something really goes wrong, and it needs to be written down. It needs to be set out in a way that can be executed almost blindly. Many banks do not have this. They will say, we'll just deal with the problem when it comes, but there can be a lot of miscommunication, and even you see it in the past that they start to focus on the media, start giving out misleading signals, which sometimes actually escalate the problem rather than calming it. And then there is a problem of correlation. And not many banks actually have done anything about improving the correlation matrices. Again, because it's a very difficult subject. Correlation can be, again, from 0 to 100%. We don't really know. And it can actually change overnight. And there haven't not been many studies that a risk professional can use in terms of applying it to the risk model. Because also I think a lot of these things are firm specific, and even though one thing might hold true for another company, it doesn't mean that you can use it for your other bank. But then you might say, well, this is all in the past. We're now in a new world. We learned from these mistakes, and this is not going to happen in the year 2015. The Basel III ratios. They were put in to help liquidity risk within Europe. I'm not going to go through any of the details, it's actually quite simple to explain. And I've been to a few conferences which deal about the Basel III regime, these new ratios. And still, I haven't seen anyone approach them as a management tool. People have all the time, in all the conferences I've been to, talk about the Basel III ratios as a compliance exercise. It's quite prescriptive. It tells you how to rank your deposit. These type of deposits are high risk. These are even more high risk. These are stable. And people are just talking about how to fill out the form. Like, yeah, should we have, like, if there's two factors, does it mean it's high risk or very high risk? This is actually not the nature of why these things were put in place. It's not put in there just to have a compliance. And people tend to believe that, well, if it's above 100%, I think actually starting point is 60% or whatever it is. If it's above 100%, we're fine. If it's below, we're not fine. Something's gone wrong. The difference is just 1%, and that is not what's going to kill the bank. These models are quite useful. They should be used. They're not perfect, but they should be used as a managing tool. A bank with a 100% ratio, let's say 80% ratio, should look at what are the main drivers why it has 80%. Is it because a certain part of the funding process is ending up in a very bad bucket? Might not be right from Basel. That bucket is 30% outflow. Might be 50. Might be 20. That is not the important question. The question is, okay, this has been identified as a high risk. Why do we have so much in there? What is driving the ratio? And that is the way to use this to manage the bank. Same thing with the NSFR, which is coming into action, I think, over the it's probably going to be another 10 years. That was effective to stop banks doing what they do. Banks do maturity transformation. Banks take short-term deposits and lend them long.
It's been suggested that we could be heading towards a period of deflation. In your opinion, which financial instruments do you feel would be potentially most affected by that?
Well, that's a good question. It's not going to happen in the UK, I think, anytime soon. That's a lucky the beginning of it, but it's probably going to be the wholesale funding. And actually, we'll come to that in a minute. Actually, it's going to be the wholesale funding markets rather than the retail funding market. The retail, we the poor public, we just give the money to the bank every beginning of every month, even though they don't give us any interest on it, and they haven't given us any interest on it for a long time. So I think it's mainly going to hit the wholesale funding. So this is what the NSFR was being put together to avoid banks like Northern Rock funding a lot of long-term assets with short-term liabilities. And there's a lot of let's say agreement now that could never happen again. Banks would never ever do this exercise again, because this is bad banking. We'll see an example of that in a minute. So this actually is a thing that we actually want to say is that it's very easy to see what has gone wrong in the past. We have the beautiful Basel III ratios, and I might believe that the problems we have now and where we're going wrong is actually not using them. So what happened to liquidity risk? That's kind of probably the question you were asking there. Well, what we have is that the central banks and the regulators, they've probably never been as forceful. The ECB is just throwing money left, right, and center at the banks. The banks have this money coming out of the windows. They have more liquidity than need. The regulators have forced the bank to also to soak up as much liquidity as they can, much more than they need. So we could actually probably say that the banks are probably much more resilient at the moment. The liquidity risk is not within the banks at the moment. And people might say, that's great. That's one less problem to focus on. That's effectively just a short-term thing. The problem with that is that the banks do not have the liquidity risk because it has effectively been transferred to the central banks. The central banks are providing all the liquidity to the market. And we know in the long run, that is not a sustainable model. But in the meantime, we can say we're happy. But that's not the end of the story. This graph here is taken from a speech that Mark Carney gave a couple of months ago. And he's saying, and I agree, that the liquidity risk has moved from the banking side to the buy side. And this again, negative interest rate will drive this risk factor. There are approximately 70 trillion pounds worth of assets under management, half of which the asset managers have promised redemption at a short notice. That's 35 trillion. At the same time, to get some yield on those funds in a negative rate environment, the fund managers have taken this money and parked them, invested them in higher yielding, less liquid instruments. And this type of funding, market-based funding, has actually replaced banks in a lot of ways. So more and more money are going into this type of funding vehicles. So 35 trillion that are at stake. And the working assumption is that there will be constant liquidity. If the owners of these 35 trillion want to get the money back tomorrow, they can. So what Mark actually said is that the risk to that type of model is only one-sided. It can only go worse than it is today. And if it does, it could be quite bad. He also added to the fact that this chase for yield, again, because rates are low, means that those who don't perform, they're going to be penalized by moving to another fund manager. So he's saying the impact of that, the spiral impact of that, could be very similar to the impact of the leverage models we had in between 2005 and 2009. The need for yield, and those fund managers who don't provide it, they'll be left out, and the investors, they will move over. And actually the interesting fact there is also that he is saying that 20% of the market, 20% of these 70 trillion is run by 10 firms. So centralization is enormous. So it's not like one fund manager would just simply go wrong because he didn't get the necessary yield to keep his lights going. It's becoming a systemic event. So this is definitely what I think is absolutely right. Liquidity risk hasn't gone. First of all, it has been masked out by a lot of money from the central banks. And secondly, it has moved houses and is now perhaps residing within the market-based finance. The big question to ask there is that, are these fund managers, are they managed in the same way as banks? Do they have the same risk function as banks? Are they regulated in the same way as banks? Do they have the same liquidity models? Do they have the same contingency funding plan as banks? And do these investors that put their money into these funds, do they realize the danger of it? Or do they view their investments similar as they would just be putting a deposit within a bank? I think there is a big risk in there. The second kind of idea that I've been working on is also from Kani's speech, is the connection of this market financing to the banks.
Sorry, a question just on the previous slide.
Yeah.
On how money is switching from the sell side to the buy side.
Yeah.
Just maybe a more critical example is really the fund of funds, in which the manager of the fund of fund is really in the middle of receiving all the investments from his investors and having to be able to manage that with the fund that he's investing in. And that's really an example of how it's really hard to manage the liquidity risk for a specific sector.
Yeah. That becomes like a leveraged investment then, fund of funds. Yeah.
Was that right?
That is effectively like a leveraged investment then. You get a knockdown effect if something like that.
You have to meet the calendar of your investors and the funds you're investing in. So
yeah.
No,
I agree with that. And then another thing is the connectiveness of the banking. Effectively means that actually the highest ratio here is in the UK. 50% of assets and 50% of liabilities is within the banking sector is now related to these parties. So if they start to go wrong, if they start to default, to have problems, the banking sector is also going to suffer because they are financing them or because they have messaged them. So there is actually, again, centralization and correlation, again, between these two worlds. Finally, another problem with this is also the centralization of clearinghouses. We have never before, if you look at 2008, banks were dealing mostly amongst themselves. Now everything is going into central clearinghouses. What if one of these houses would fail? They are now part of the sterling monetary system, so they can get access to the Bank of England. But still, if one of them would fail, it would be a catastrophic event to the system, much more than one Lehman Brothers would fall. So the system is getting more and more centralized, and therefore perhaps more and more vulnerable. Can the perfect storm happen again? This was a Northern Rock history, and we know this is not going to happen again. Below that is the fourth biggest bank in the UK. I'm not going to tell you which bank it is, but it's not that different, is it? And people said, well, this is what the people in Northern Rock were doing, taking short-term liabilities and using them to give mortgages. Not a good business. This is another bank. Same risk. Not necessarily. The bank above would not pass the Basel III test. Northern Rock, if we're still alive, would not pass it. The bank below will pass the NSFR test because they've changed their assumptions. They've said, well, you can have short-term liabilities if they're stable. When they introduced the NSFR in the beginning, it had to be long-term liabilities, long-term funding. Then they realized there wasn't that much long-term funding in the world. So they said, okay, you can actually compensate that with short-term funding, but it needs to be stable. But that was also what Northern Rock thought when they did it. They were quite sure that the short-term liabilities, they were quite stable. They were from vehicles that issued AAA rated paper. It cannot be more stable than that. But the assumptions were wrong, and there's nothing to say that assumption cannot be wrong again. We are definitely going to have events where let's call it Titanic events, where something goes wrong, but it's only going to hurt those who are on board. The rest of the people are going to be fine. I think that is for sure. We, again, have seen the Swiss franc example this year. We're going to have that. Are we going to have the perfect storm? It's difficult to predict, but I'm quite sure it's not going to happen anytime soon. But the yellow cards and the yellow lights I see in the system are this huge centralization, which is coming now not only in the UK, but also across the world. Everything, it's also banking mergers and stuff like that. It's becoming like a one big organization. And that means effectively that the organizations we have today are effectively much more similar to each other than they were perhaps 10 years ago. We could have banks that one bank was doing this, another bank was doing that, completely different. Now if you look at the biggest players in the world and the biggest clearinghouses, they're all identical. So if one goes, chances are the next one will go. And that is a perfect storm. That's all I have for today. I think I've spoken far longer than I expected to, but thank you all.
Thank you very much. I just want to say a few things before we move on to drinks. Gudni is obviously one of many prestigious authors whose books are included in the unique Garb Wiley bookstore. And the bookstore offers hundreds of carefully chosen print book titles at discounts from 40 to 65% of list price, along with access to 14 journals and free monthly ebooks. Access to the bookstore is a benefit for all of you who have a paid membership in Garb, and you can find information among the materials on display at registration. And I would also ask you to leave your badges with registration before you leave. That would be very helpful. Thank you very much again. Let's go to have a drink now.
Thank you.
Cheers.